you did not foresee this global pandemic coming, but it's not just the pandemic, is it right? The market structure, the debt loads, everything else that was already in place, the pandemic may have just been that chip on the Jenga stack, if you will.
Yeah, I mean, Brian, if you want to think of it as a house of cards that was built by the policymakers in order to bail out the financial system during the crisis, one day, a breeze came along and knocked over one of the cards, and it's bringing the whole house down.
Well, the house, listen, Scott, the equity market rose 13% this week. I understand we're still well down on the year. Seems like the Fed is shored up the credit markets a little bit, but it sounds like you're not believing that the bottom is in yet.
No, I don't think so. Brian, when we look at some of the data that we're getting with unemployment insurance claims and so on and so forth, it would suggest that we're going to get to a place worse than the financial crisis economically. Unemployment perhaps around 15%. An economic contraction for the year, let's say maybe in the neighborhood of 10%. These are pretty nasty numbers. And when you look at valuations on stocks, the degree of overvaluation where we were at the peak just 6 weeks ago versus the peak in valuation that occurred in 2007 has been much more extreme. And the decline we got from the downturn in 2007 was a 55% drawdown in stocks. We've been around 34% so far. It just doesn't seem that, given the economic backdrop, that the prices have adjusted to reflect economic reality.
Yeah. But I'll push back a little bit, my friend, because I remember in September of 2008 going down to D.C. and having meetings with congressional leaders to explain to them what a credit default swap was. And then months went by before we got really anything done. They were slow. This time, in the course of a week, we got the Fed throwing probably $7 to $10 trillion at it with leverage and a $2 trillion relief bill. Aren't you encouraged at all by the speed, and I can't believe I'm saying this, the speed at which D.C. reacted?
Look, Brian, it's a lot more encouraging than the financial crisis. And, one thing that we identified years ago was the reaction function by the policymakers this time around in the next recession would be much faster than the financial crisis. That, gave us a lot of confidence that the downturn would be much less severe than the downturn of the financial crisis. But nevertheless, even with a mild downturn, we would expect to see about $1 trillion worth of investment grade debt go to below investment grade. We would expect to see default rates on corporate bonds get into double digits. And now there's a pretty good argument to be made that, this is more severe than just a mild downturn. And the tools the policymakers are using, I'll put them into the category of necessary, but not sufficient. David Zervos, who you just had on, a very, very smart guy in my mind, made some observations about, things like asset-backed securitization. But those markets are completely dysfunctional right now. So there is no liquidity there, and we rely upon the securitization markets to provide capital for not only credit cards and
Scott,
automobiles.
we heard. I'm sorry to jump in on you, buddy. It's harder to jump in when we're both remote. But I understand what you're saying, and some of the stuff I heard anecdotally last week at the beginning of this week was downright scary. But I've also heard that things are opening up a little bit in terms of liquidity. Are you not seeing that from your perch?
Yeah, we're definitely seeing it, but it's a world of haves and have-nots. The have-nots are in the high-yield bond market. The haves are in the investment-grade bond market. Okay, we've got that propped up, but the bond markets in the United States are a lot bigger and broader than corporate bonds, and a large swath of the bond market is still not propped up, and it's going to take a massively I think, a massively larger set of programs to address all of these pockets of illiquidity in order to get everything to stabilize.
You put out a paper. I'm going to read it, and you'll forgive me. I got to look at my screen. I'm just kind of flying blind here. This is part of the paper you put out. I believe is up on CNBC.com as well. The total debt of U.S. non-financial businesses has grown by about $6 trillion since 2007, while cash on hand has only grown by $1.7 trillion. A big driver of that debt growth has been buying back stock. How angry or annoyed should the investing and American public be by that statistic?
Brian, first off, let's turn to the policymakers. The policymakers in Washington ran policy to encourage this behavior from corporate America, and as a way to successfully drive up the market prices. The disturbing part is when you start to see whole industries like airlines, who bought $45 trillion of stock back, $45 billion of stock back over the last decade, and now they want a $50 billion bailout program. I think there's going to be a popular backlash against this, and as the programs potentially have to expand to bail out, the hotels and the car rental companies and the energy companies and the whole bit, I think that Main Street and Middle America is going to look at it and say, once again, Washington's saving the fat cat and not caring about us.
Because the bottom line is you can't blame anybody for what's happening with the pandemic, but we can go back and say we should never have built up trillions, tens of trillions in debt. Is that shorter-minered?
Right. Yeah, that's right. And by the way, Brian, I've been out there lecturing on this for umpteen years now, that this would ultimately be the crisis we would face. And as we used to say back in the mountains where I grew up, the chickens are coming home to roost.
Scott Minerd, Guggenheim, pieces up on your website and CNBC.com as well. I urge everybody to check it out. You have a great weekend, my friend. Stay safe and healthy. We'll talk soon.